Okay, so thank you guys so much for coming to the fourth session of the summer series hosted by Wise Youth Society. So just quickly going over the organization itself, Wise Youth is a nonprofit that is youth-led and is dedicated towards empowering youth by providing them with resources and opportunities to enhance their financial literacy skills. So for this summer, we have planned this series that's going over some basic finance knowledge. And today I'm very excited to have Owen here with us, who will be going over some basic ideas in terms of accounting. So just before we get started and Owen gives his own introduction, I'm going to briefly go over some important notes for today's webinar. So the basic formatting of today is we're going to have roughly a 30 to 40-minute presentation style that a presentation that Owen prepared for us. And in between those presentations, in between his presentation, there's also some small breaks where you guys can ask any questions you have. So throughout the presentation, feel free to use the chat box or the Q&A function that Zoom offers to ask any questions you have regarding the presentation. And at the end, Owen has also prepared for us a small Kahoot game. So if you're interested in playing along, please stay tuned for the end. So that's it on my end. I'm going to pass it to Owen now, who will begin his presentation. Thank you guys so much for coming today.
All right. So as you might know, my name's Owen. I go to Collingwood School, and I'm really like involved with the business there. So, I created a slideshow talking about like the basics of accounting and like how like accounting really works. Because I know a lot of colleges really offer like times or like maybe you're looking like some accounting business schools. So I know it might be like really confusing. However, I hope this can like sort some things out and maybe you can have a clear understanding of accounting at the end. So for the slideshow, I'm gonna have a game at the end. So if you want to stay around and just play the game to test your accounting skills, I think that'd be great. That'd be a really good practice for you. But if not, feel free to leave. So to the first slide of my accounting slideshow. What is accounting? So there's a lot of like there's a lot of types of think inside the head. Oh, like you're counting money. Maybe it's a sort like a type of counting, which I used to think when I was like 3 years old because my dad was reading a business magazine and I just looked at the accounting section and always every time I was like, are they counting money or like are they doing something else? But accounting is basically like you're looking at the like financial transactions. For example, Visa has a really big accounting team because they have to look at all of the like financial transaction. It doesn't matter if it's like wire fraud, which they like really have to look at, or if it's something else that people are just like giving money to each other, like via PayPal or something else. Every bank or every like financial service always has an accounting team there for the purpose, for the sole purpose of just keeping everything in order because your business cannot function if it's like basically on the basis of where like you just try to you just try to stretch your business out and try to like reach more people. However, if you don't have like a balance sheet or if you don't have something to keep track of where your business is currently at, you cannot progress forward. So really like accounting is like looking at financial transactions or just the health of the company. If the company is doing bad, like the start of JP Morgan Chase, it wouldn't be the balance sheet or the accounting team wouldn't be doing a great job at like really measuring and taking a good look at the current health of the company. So it's normally just taking a look at the company and also for the very bottom part the assets equals liabilities plus equity. So we'll get into that equation later where it's like a really big rule. It's kind of like it's kind of like some really big accounting rule that a lot of people follow by, or it's just like a universal rule basically. Now for my second part, which is the savings part. So I know this might not be something accounting really talks about. It's mostly like financial literacy. However, when you're doing accounting, you're not just looking at the health of the business, you're also looking at how you can improve the business overall. So if you're working like a 9 to 5 in the accounting desk, you're looking at the health of the business. And if you're working at, for example, JP Morgan, you're going to be looking at, wow, this company is doing really well financially. However, is this the best we can do, or is this like the maximum amount of work effort we can put in? If not, you can look at the savings, or you can look at what the company has stored in its business card or in its business credit. So you can look at that and go like, if we just started to invest more into like more tech companies instead of buying buying like the fruit company or any of those other companies, I think our savings might be better, or we might have more money for emergency fund if the stock market crashes again. So savings is a really important part of accounting because when you have your savings, or when you have your savings on your balance sheet as an asset, you can take that asset and you can just say, this asset, we might need to change it a bit. We might need some people to like really like do like really look at the database and really look at what the saving situation is currently like, if we're losing money or if we're like storing money for the long term. So for my third part, which is the banking system like JP Morgan Chase is like, your parents probably do have a credit card or some form of payment. So because so your parents have that payment method because of banks. So what banks do is that they hold money and then they just store for you. Basically, if you're just trying to like hold money somewhere, or if you're just trying to open like a savings account, you have to go to the bank. Or if you're trying to like buy a stock in the past, like in the 1920s, you would have to go to a bank to actually buy the stock. Now, banks are really part of like assets or your liabilities because of like the value that it holds. You can't be having like you can't be doing like Ponzi scheme, or you can't be doing like any other thing if you don't have a banking system, or if you don't have another thing that you're like getting your money from. So really, banks are just something that you can just hold, or where you can just put your money in, and then the banks will just like kind of take care of it. Maybe they're gonna take like 1% annually each year, just judging by if you're making money or if you're losing money. If you're losing money, the banks are probably going to like cut a deal with you, or maybe they're not going to like treat you like as a better client than other well-known people who actually like pay their taxes and pay everything on time. And that leads me to debt and credit. So debt is like basically a loan. You're missing money out of your bank account that the bank holds. So when you're in like need of buying a house, for example, you you borrow a loan, or you're in debt right now. So debt isn't really like if you're puncturing the line of $0, or if you're going up $0 where you're not in debt. So debt is kind of just a loan where you're just taking a small amount of like money from the bank, for example, or if you're just going to pay that debt back to the bank in like 3 months, or else it's gonna grow larger and they might have to take away the house that you just bought, or they might have to take away the car that you just bought. And some loan types are like personal credit card, mortgage, and like college funds. And normally, like as you can see on the slide, like there's probably interest rate on that debt. So let's say that you use $10 to buy a can of like Skittles. Like over time, if the interest is 25%, it's gonna slowly go up 2.5%. So it's gonna go from $10 to maybe $12.5, and it's gonna slowly go up from there. So from $12.5, they're gonna add another 25% on from that 12.5, and then you're gonna have more debt to pay at the end. So this is like the time because I know I've been talking a lot. If you have any questions for me or if you have anything to like say, feel free.
I think there is one question in the Q&A box. Someone asked, you said Ponzi scheme, what is that?
So Ponzi is like a person. When Ponzi was actually when he was younger, he spent like a lot of money that his mom gave to him on like fancy clothes and fancy shoes. So when he was older, he wanted to make like the money back so he can make his family proud. However, he created kind of like a scheme where you have like the bank is the main target. And when you like look at the bank, for example, you kind of go like, wow, there's a lot of new investors that like want to like get into investing or get into the stock market. So we can go, we have like really high return rates. For example, like 20% return. So if you give us like $100 at the end of the year, you might have $120. So they just promise really high return rates. At the end of the year, they don't give your money back. That person who manages like all the funds, like the Ponzi, I'd say, the person who manages all the funds, like it keeps it there, and then he just gives that to another person who, which that person they could either gamble it away or they could just like store it in their personal bank account. So when when Ponzi declares bankruptcy, the other person and Ponzi could like split the money, and then at the end they would have like $100,000 because it used to be a really big fraud back in like the 1920s or the 1930s. All right. Is there any more?
I think you can move on.
All right. So to my next section, which is like still talking about loans, we're gonna like dive into more depths of like the how the loan system works, like how you can take loans. So like one type of loan is the student loan or the college loan, where you like basically take for your college or where you take for your university. So if you don't have the amount of like the certain amount of money to actually go into that college, you can just like take a loan out so you can like go there. And like what it normally is that each year that you stay at the college or the university at, you have to pay like a certain amount of money. For example, like let's say the basis or the principal is like $10,000. And then for each year, you have to pay $10,000 to that bank or to that university. So so let's say you're doing like 4 years of like law school. Each year, you're going to be paying $10,000. So at the end, like the total is gonna be $40,000. And then normally the maximum length would be like 10 years to pay that because at the end you can't just have your student loan be piling up or you have to file for like Chapter 11 bankruptcy. So when you're like really using the student loan system, you have to be really careful of like how much money you're using or like the tuition fee for that university. So yeah, that's something that you have to like be really clear about. All right. And then at one of these is compound interest. So you probably have had like heard the term compound interest. So compound interest is like mainly just like interest that builds up. For example, I gave you the like the example of the 12.5% going up each year and annually. It's going to become like $3,000 at the end of the year if it just goes up by 25%. So let's say that you borrow money from the bank, you don't put it in like your notebook saying like, oh, I borrowed $10 from the bank today. You just store it there, and then let's say it goes up by 50%, or like normally the bank it would only go up by like 1% normally, but let's say it goes up by like 50%. So like it'd go to $15 in 1 year, and then it'd go to it'd go to it'd go to $225 in the next year, and then later it just keeps on growing. So the more money you put, the higher you have to pay, or the higher you earn. So just be careful about the mo amount of money you're really putting into something so that you don't have a lot of interest at the end. And then something to do with compound interest or something that's really important, stocks. So stocks is a really big system, so I'm not going to like talk about all of that. So for a summary, stocks are literally just like ownership of a company. For example, like Tesla in 2020, for like the third or fourth quarter, they had a growth rate. And then let's say you bought like 1,000 shares of Tesla, you'd be owning like a lot of the company, or like you would be owning some of the company. So one share is like, for example, like 1% of the company. So like a penny stock, which is like hence the name, it's like basically worth a penny, or like half a penny. So when you buy a stock, you're basically buying like some part of the company. For example, like yeah, t like Tesla, you bought 10,000 shares of the stock. At the end, you might be owning like maybe 3% of the company, judging based like how much shares they have. So like a company has to open like a IPO, so they can like so like IPO is like initial public offering, where the company that wants more people to invest in it, like it opens it to the public, so the public can go like, wow, I see a lot of potential in the company and I believe in it. So somebody buys one share of the company, which they basically own some of the company at that time. And also for stocks, there's dividends, where basically if the company has like exponential growth rates, for example, Apple, they promise dividends at the end. So if you have like if the company offers dividends, it doesn't have to offer it. However, if it does, you're basically like you earn back, you invest $100, it grows, what you get back $120, but you also get back $30 because it's like a kind of extra bonus to invest more. All right. And then any more questions?
There is one question in the chat, in the Q&A. I'm just gonna read it. So someone asked, I thought accounting was money management. How does investing, I think they're talking about like the stock side that you talked about, relate to that?
So like stocks for a company, I think I talked about like the saving aspect of accounting. So, like stocks, a company can't just like hold their money, or else you know like what inflation is. Like inflation kind of just chomps away at your money. For example, $1 bill in like 2020, right now it would be only worth like maybe 70 cents because of inflation. So if you just keep on holding a bunch of money in one place, inflation is gonna get chomp away at it. So a company, they always have a team that like buys stock for them, because they can't just like keep on holding money there, just like letting inflation eat away at it. They have to use that money so they can use that for kind of like a liquid asset. Or a liquid asset is kind of like their net worth, or like how much they currently own of the stock market. For example, Hudson Bay Banking, or some bank in Hudson Bay, they own like estimated 5% of the whole stock market, because they don't want their money to go away and just be eaten away by inflation. They buy stocks so that their money doesn't get taken away into somewhere, into like it doesn't so like the money that they have doesn't lose value at the very end. And then for the next chapter, mutual funds, or just funds in general. So mutual funds basically allow people to like diversify their investment. For example, like if you're like buying like an ETF, for example, or if you're trying to like buy like an ETF is basically a mutual fund. So you probably heard S&P 500, but if you didn't or if you haven't heard of that before, it's kind of like a mutual fund where a really like 500 most valuable companies in America are put into one fund or put into like one stock or one ETF, where you can just like where you can buy the ETF or you can buy a share of the ETF, and you're basically just buying all of those companies. Not like the whole company, but you're buying a share out of all those companies. And the difference between like just buying a loan from the company or buying an ETF is that you're not like really like all the shares from those 500 companies aren't going to be added up together into one share, and then you have to buy and you have to use like $10,000 to buy one share. No, it's kind of like you have, let's say that at the end, all of those companies added together are like $10,000. It's not going to be $10,000 for one share to buy the mutual fund, but you have to, it's kind of like you, like S&P has its own like share. So the S&P right now, it's probably like 200 or $114 at this moment. So yeah, you basically just you use $114 to buy a mutual fund, and then at the very end, that mutual fund is going to be like it's going to be diverse into 500 different companies, and at the end, like annually in a year, it's going to grow like 14%. And like if you're going to buy stocks or try to grow your money, I would recommend always buying mutual funds or always buying ETFs like the S&P or Nasdaq. And then taxes. So my parents really dislike taxes because in Vancouver, like there's a lot of rules about taxing, or just like in America, like I bet your parents also don't really associate themselves with like the taxing system because they don't really like it. And as you might see here, there's like income tax, sales tax, real estate tax. They're both they're all those three are really big tax systems with a lot of like things branching off of it. But if I was gonna like summarize taxing, I'd say it's kind of like the government takes money from you or your parents, and they can use that money, for example, like to fill potholes like in your road, or they could use that money to fund different like communities. For example, I think for one of the businesses or for one of the organizations I'm a part in for my school, they actually like the one of the sponsors for our company was actually the government, and then we got that sponsorship because we pay our taxes. So if we didn't really pay our taxes, there wouldn't be any money to really help the people. So you're kind of giving money to the government so they can help you back. And then for one of these Social Security, I won't get into Social Security a lot because I don't think it aligns with accounting. However, Social Security is basically like basically all your assets and all your liabilities put into accounting. And then insurance, a really big part of accounting. And this is like a super important part of accounting. When you look at your insurance, you don't want a bunch of like companies just coming at you. For example, if you're in a car crash for your business, or you just bought the car on your business card. So if you have insurance, it's really important for the company. So if any accident happens or if anything happens, like the insurance company will look at the accident goes and they're going to go like, oh, this is like totally the other person's fault. They're faulty for the accident, so the other person or your insurance company has to help you repair. For example, like if you got into a car crash, your car is totaled, the other person like swerved into you because they're drunk. That like insurance at the very end, that's gonna help you a lot because if you didn't have insurance, it'd be your fault. It doesn't matter like if the other person was drunk, it's you'd still have to pay for the other person's car. And if you had insurance, you would be like you would also have the advantage there in that situation. So insurance is kind of like a safety net for like when you fall or when you have an accident or when you like don't go into the best situations, you always have something to like back you up. And then retirement funds. So I know there's a lot of words and I'm speaking a lot. So a retirement fund is basically just something that people use. So when they retire, they slowly put like when you're 20 years old, you're obviously like if you're not a millionaire, you're not going to retire at 20. There's probably going to be like building your life at 20 or you're probably going to be in college at 20. So if you made like $13 each year, the government would take like normally they would take 6% or your business would take 6% of your paycheck. And then later, when they take 6% of your paycheck, they don't just like take it away and just put it in their own bank or their own card. They take that 6% and then they put it towards your retirement fund. For example, if you're like, I think there's a question.
Yeah. Someone asked, does insurance price vary depending on age? So I think it's back to the previous slide.
So insurance. Um, so if you're like below the legal age to like to get insurance, so your parents would normally get insurance for you because like if you like broke your arm or if you like had an accident like while riding a scooter or something, you would like have that insurance so that you wouldn't be accountable for the things that you did, or you wouldn't be accountable for the accident that happened. So basically, your money would be safe. Won't have to use your money, and instead, the insurance company will help you like manage your money. And also each year, you can't just like get insurance. You have to pay like each year if you got into like a lot of accidents, the insurance company is gonna look into that going like, are they committing insurance fraud? Because the insurance company, they help you fix the problem, but they also like promise to give you some money at the end, like $500 to help you like get steady in life. So you can't just like keep on committing accidents to yourself just so that the insurance company will like give you $500 each time you commit an accident. The insurance company always has like this sort of team which looks into the accidents and which looks into like how that really happened. And then after retirement insurance, health insurance. So I think I just got into that where when you get injured or when something happens, the government also offers health insurance where they basically just look at your health. If you have a heart attack or if you have a stroke, they go like, we're gonna pay for these medical bills, and that's super important in America. Like in Canada, of course, you have free health insurance, however, or free, yeah, you do have free health insurance. However, in America, like an ambulance ride would cost like a minimum of like $1,000 or $500, right? So health insurance is a really crucial part. So all like every time when you look at your book, always have a tab for health insurance so you can just look at if your health insurance is like overdue or if you have to pay the company. Because if you don't and you eventually like you probably will get into an accident, you really need health insurance there for you. Because if you don't, you're gonna drain like $300,000 just to work on some medical bills. And then questions. All right. So last three tabs and then the game. So for the first tab, balance sheet. So balance sheets are kind of like the very main core, which kind of like makes up accounting. So the balance sheet basically like it looks at the company, it looks at the company's vitals. So like an example of that would be like in a movie, if you're looking at the hospital, you would see like the person's heartbeat, you would look at like the blood pressure. the balance sheet is basically like that thing that monitors the person's like heartbeat and manages like and looks at the person's like blood pressures. For example, if that person flatlines, the company or the balance sheet, for example, would like be really will be like full of zeros or be full of like ones or twos because that person isn't like doing as well or the company isn't doing as well. So three main parts which are really important is assets. So assets are kind of like what the company owes, or it's kind of like what you would call the equipment. So equipment is basically like what you have. So like assets could be something you owe, like a debt, or assets could be something you like you have. For example, like $100 that you earned. That would be an asset because that's like your total monthly or yearly profit. And then for liabilities, liabilities is basically assets if you lost money. They're not looking at what you like have, they're looking at what you owe. For example, if a company has like insurance, if you bought a car under the company's name, when you get into a accident, the the liabilities tab for like health insurance, it eventually like go to 3,000 because when you have to pay your health insurance, you're gonna be like paying $3,000 to that to that team or you're gonna be having $3,000 for your liability tab. And then owner's equity. So you could also just call it equity. However, owner's equity is kind of like a single business type of thing. So owner's equity, known as like shareholders' equity, is kind of like the last bits of interest, like in the assets. So let's say that people have like $3,000. You, like the person or like let's say somebody like didn't pay their debts on time. If you're running a banking system, you would have a tab in your balance sheet for for the owner's equity or for what the person owes to your company. For example, if I bought some smart water yesterday and I didn't pay, like if I bought it and I just like kind of I'd go like, oh, I'm gonna pay this to you tomorrow. And if I don't pay it to you tomorrow, I can give you $20 extra. And let's say I didn't go back to there tomorrow because I forgot, or maybe I just like stole the water, you would be having to pay, um, you would be having to pay that company more money than you originally owed, and that's owner's equity. So a really important part, like I just said in the first or second slide, is assets, is liabilities plus owner's equity. So keep that in mind because you might need that in the future if you're doing an accounting business. And then for the income statements. So income statements is basically just if we're diving into the assets part. So for the income statement, it's three main parts: revenue, expenses, and net income. So for the revenue, it's like how much you earned at the end. So if Mary was like doing a lemonade stand business, she would be selling each cup was like 3 cents. The lemonade and the ice, and then the water would be like 30 cents. And then she's in total at the end of the day, she sold like $33, right? So at the very end, her revenue is going to be like 33 minus 33 cents for all the things that she had to do. So revenue is like at the very end, at the very, very end, when everything is taken away from the equation, that's how much money you earned. And then for the expenses part, it's how much like it's kind of how much like it's kind of like in the equation, how much money you owe. For example, as I said, like Mary owes 33 cents because she like bought the cups and she bought the water and she buys all that. So expenses are kind of like the water, the lemonade, the ice, and all of that stuff. And for the net income, it's how much you're like estimated to have. Or for example, if Mary like eventually she has a lemonade monopoly, or if she has like a really big business selling lemonade Mary's gonna have like a net income, so it's kind of like the part of the balance sheet where you don't like really know all of that, where you can't know like everything about the business. However, it's an estimated public guess. So if you're working for the company and you're part of the accounting team, you would know how much income you have. However, if you're like a reporter on the outside, you would you would be having to like guess or estimate how much money that company has owed. And then for the very last one, cash flow statement. So for the cash flow statement, it's like how much, it's like if I was going to summarize it, like the cash flow statement would be like the flow of cash in and out the business or like over a period of time. So the cash flow statement would be like, oh, how much money did we spend in 2020 and how much money did we like earn in 2020? So it's a series of events, like a timeline kind of like what really like all the turns that happen in the company. For example, there was a banana company in the 1930s which had a lot of expenses. They literally had like fleets of ships to export, and then they would have a really big list of cash flow statements, which they would have just like sitting there, and it'd be like maybe like 30 pages long because of like the banana tax and all of the taxes for exporting and shipping the bananas. And then for another one, for these three operating activities, investing activities, and and financing activities, these three things are really just like operating, investing, and financing. They're not really just activities. So as I just said, it's a timeline of events. So for financing activities, for example, that would be just a timeline of like all your finances. And then investing would be a timeline of your investing. And then for operating, it's like how much you're paying your workers or how much you're like using to export. So cash flow is just like a timeline of events or a timeline of the money that you used for your company. And then for any last questions, if you can't think of one right now, you can just like tell me later or you could just email Wise Youth. All right.
I think maybe we can move on to the Kahoot that you prepared.
All right. So for the last bit, the Kahoot. All right. I'll just paste the code into the chat if you guys need it. Just keep it here actually.
Owen, do you not need to like open up the Kahoot, like the code?
Wait, is the code not here? Oh, wait, no. I'm
I
gonna
think,
share it.
yeah, I think you need to like open up yeah. So feel free to join on in this Kahoot. It's just gonna review everything that Owen talked about today. And it's also a pretty fun game. It's gonna be multiple choice only, so it's pretty relaxing. I'll play too. I'll see if like more people join in, but because it's going, oh, because oh, more people are joining. Never mind. But I was just gonna say if there's not that many participants, then maybe we can just kind of look over the questions themselves and just kind of do the review from like that. Because if it's like only two or three players, it might be a bit boring. Mm, okay. It seems like there's maybe some people are having internet troubles or they're not familiar with Kahoot. So how about instead of playing the game, I know that you prepared it, but how about we just go over the questions themselves? Because how many questions did you have prepared, Owen?
It was 20, but I think that's like a bit too much.
Okay, yeah, maybe we can maybe go over the first 10 or you can also pick the ones that you think are the most important.
All right, I'll just do like three really important ones.
Okay.
Um, so for one of these, it's the yeah, it's the like financial statements. So like of course, financial statements are like showing how much money like you're paying or how much like or the specific period that you're going to be paying those.
Mhm.
So like basically if you're like paying the expenses for the company, you're going to be having like you're going to be having like a financial statement, which is also going to be known as like an income statement. And then I think one of those was question number six, which is the income of a company that receives it from like the normal business. So like this is really important for the asset or for the um accounting business because it like teaches you how much of that company or like how much of that company receives from the normal business. And then I think the last one was 18. So income statement is called we did income statement is called loss like profit or loss margin. So how much money you lost or how much money you like reinstated into the company. So that'd kind of be like what an income statement is. All right. And then those are the like the three that you kind of need to know for accounting.
Okay. Yeah, that's amazing. Yeah, sorry again for not being able to play your Kahoot, but you could totally send me the link and then I'll put it somewhere and then people can also review the questions afterwards. But this is the cl- this con now we're going to conclude today's webinar. So thank you so much, Owen, for participating and being the speaker for today and giving us such a comprehensive presentation of just a short introduction to accounting. Of course, the topic itself has a lot more depth to it and there's a lot more aspects. I think there's a joke that goes around that accounting is kind of more so the boring aspect of finance because of the amount of numbers you have to go through. But people who are very numbers orientated, maybe this is something for you and maybe something you like to explore more in the future. And just before we let you go, I just want to let everyone know that the recording for today's webinar will be posted on the website. So if you had friends or family members who weren't able to come today because of conflicts, you feel free to send them the recording so that they can also learn more about accounting as well. Also, just briefly talking about next week's webinar, we have one planned for Sunday rather than Saturday, and the information for that will be sent out early next week. So stay tuned for that. If you guys have any questions, feel free to email us, contact us through our website. We also have a WeChat, so feel free to do that as well. So yeah, thank you guys so much for coming today. Thank you, Owen, once again, and hope you guys all have a good evening or good morning to wherever you guys are in the world. But yeah, thank you guys so much for today. Bye bye.